Want smart, low-cost exposure to the whole market without picking stocks or paying sky-high fees. In the next 20 minutes, I'll teach you ETFs from A to Z so you can invest with confidence, even if you're starting with $100. Stick around. I'll show you the exact steps most Americans use, the biggest rookie mistakes, and the simple checklist I use when I evaluate an ETF. Real quick, I wasn't born knowing this. I started with a single index fund, messed up a few trades, learned the tax quirks, and then discovered ETFs. They changed everything for my investing. If you want the same simple, repeatable toolkit, you're in the right place. 1. What is an ETF? First, what exactly is an ETF? ETF stands for Exchange Traded Fund. Think of an ETF as a basket of securities, stocks, bonds, commodities that trades like a single stock on an exchange. When you buy one share of an ETF, you own a slice of that basket. The U.S. investor protection agencies explain that ETFs are registered investment products that trade intraday like stocks, but hold diversified portfolios like mutual funds. Investor.gov. 2 important simple points to remember. 1. ETFs trade all day at market prices, and 2. They usually represent a pooled portfolio, often tracking an index. 2. How ETFs actually work. Here's the neat behind-the-scenes mechanism that makes ETFs different from mutual funds. Authorized participants, big market makers, can create or redeem ETF shares in large blocks by exchanging the underlying securities with the ETF sponsor. This creation/redemption process helps keep the ETF's trading price close to its net asset value. And it's the reason ETFs can be both liquid and low cost. If you want the deep read on the mechanics, asset managers publish plain guides to how creation and redemption work. In practice, this means when people buy or sell ETFs, the supply can adjust efficiently, which keeps prices honest compared to the value of the underlying basket. 3. Why many US investors like ETFs? Why are ETFs so popular? Short answer: cost, convenience, and transparency. Low cost. Many ETFs have tiny expense ratios, often far below equivalent mutual funds. Tax efficiency. Because of the creation/redemption mechanism, ETFs often produce fewer taxable capital gains inside the fund than mutual funds do. That tax efficiency has saved U.S. investors a lot of money over time. Big picture studies and market commentators have noted meaningful tax savings from the shift to ETFs. Financial Times. Trades like a stock. You can buy and sell all day, use limit orders, and set stop losses, which is handy for execution control. Choice and transparency. There are ETFs for almost everything: total market, dividend stocks, international, bonds, gold, thematic plays, and holdings are usually published daily, so you know what you own. Investopedia. These advantages make ETFs a go-to for many DIY investors and financial advisors. Section 4. The main risks and things people get wrong. ETFs are powerful, but not risk-free. Don't fall for the ETF equals safe shortcut. Key risks to watch. Tracking error/structure risk. Some ETFs, especially niche or exotic ones, don't track their benchmark tightly. That can be costly. Liquidity and bid/ask spreads. Very low volume ETFs can have wide spreads. That raises trading costs even if the expense ratio is low. Concentration and style risk. A sector or thematic ETF can be as volatile as a single stock if it's concentrated. Underlying asset risks. Commodity, leveraged, inverse, or some fixed income ETFs carry specialized risks and aren't appropriate for buy and hold in taxable accounts. Tax quirks. While ETFs are generally tax efficient, certain ETF types, like some commodity trusts or bond ETFs, have different tax treatments. So placement across taxable versus tax-advantaged accounts matters. Short story: know what's inside, how it gets taxed, and how liquid it is before you buy. 5. The practical checklist. How I pick an ETF. Here's a short checklist you can use every time you evaluate an ETF. Put these on the screen as a 6-point checklist. Objective and index match. Does the ETF actually track the index or strategy you want? Read the prospectus and holdings. Expense ratio. Lower is usually better for broad exposures. Fees compound against you over decades. AUM in volume. Bigger assets under management and higher daily trading volume usually mean tighter spreads and less risk of closure. Tracking error history. Look at how closely the ETF has tracked its benchmark. Tax efficiency and structure. Is this an in-kind ETF, or does it distribute a lot of capital gains? Some bond or commodity ETFs behave differently tax-wise. Corporate, Vanguard.com. Fit in your portfolio. Do you already have overlap? Don't buy an S&P 500 ETF if you already own the total US market and multiple S&P funds. You might just be doubling up. That checklist removes emotion from the decision. Section 6. Basic categories of ETFs. Let's keep it tight. Here are the main categories most US investors use. Broad market / core ETFs. Total US stock market, e.g. VTI, S&P 500 ETFs, e.g. SPY/IVV. Total world ETFs, great as portfolio cores. International ETFs, developed and emerging market exposures. Bond ETFs, short, intermediate, long, tips, high yield. Be careful. Bond ETFs trade like stocks, but the underlying bonds have different liquidity. Sector and thematic ETFs. Technology, healthcare, clean energy, higher conviction and higher volatility. Commodity and specialty ETFs. Gold, oil, volatility products. These are tools, often not long-term core holdings. Active ETFs. Managers try to outperform index benchmarks. Fees are higher and strategies vary. Keep an eye on turnover and tax implications. Most investors start with broad market ETFs and add targeted allocations later. 7. Where to buy ETFs and the simple steps. Buying ETFs in the US is straightforward. Open a brokerage account. Choose a reputable broker with low commissions and good tools. Many brokers now offer commission-free ETF trading and screeners. Search and screen. Use the brokerage's screener or independent sites to filter by expense ratio, AUM, and performance. Place the trade. Use limit orders if you're concerned about spreads. Otherwise, market orders are fine for large, liquid ETFs. Decide where to hold them. Taxable account, traditional IRA or Roth IRA, based on tax characteristics. Vanguard and similar sites have step-by-step how-to guides for buying ETFs if you want to walk through. A simple default for many US investors. Buy a total US stock ETF plus total international ETF plus a total bond ETF. Rebalance yearly. That's 80% of what you need to know to build a diversified portfolio. 8. Tax placement rules. Quick tax placement rules. Don't ignore this. Put tax-efficient ETFs, broad index equity ETFs, in taxable accounts. They tend to generate fewer internal capital gains. Place tax-inefficient assets, some bond funds, REIT ETFs, commodity trusts, in tax advantage accounts to avoid high annual tax bills. Remember capital gains on selling. Even if an ETF is tax efficient inside, when you sell your shares, you may owe capital gains tax. Understand holding period rules for long-term versus short-term gains. The structural benefits of ETFs have saved investors significant tax drag compared to mutual funds. Financial Times. If taxes are a big concern, talk to a CPA or tax pro for tailored guidance. Section 9. Sample portfolio templates. Here are 3 sample starter portfolios. Examples only. Adapt to your age, goals, and risk tolerance. Conservative for someone near retirement, 30% total stock ETF, 70% total bond ETF. Balanced classic, 60% total stock ETF. Split 70/30 U.S/INTL, 40% total bond ETF. Aggressive, long horizon, 90% total stock ETF, broad US plus international tilt, 10% bonds or cash. Again, pick one, stick to it, and rebalance once a year. Rebalancing forces you to sell high and buy low. It's one of the simplest edges investors have. 10. Common rookie mistakes and how to avoid them. Don't do these. Chasing last year's top-performing sector ETF, performance mean reverts. Owning 10 overlapping ETFs that all hold the same mega-cap stocks. You're not diversified, you're redundant. Using leveraged or inverse ETFs as long-term buys. These are short-term trading tools. Ignoring bid/ask spread and trading costs. Cheap expense ratios don't erase trading slippage. Use the checklist we covered earlier and you'll avoid most traps. Section 11. Final quick tips and call to action. Final quick tips. Keep fees low. Know what you own. Use tax-efficient placement. Rebalance yearly. Learn the simple math of fees. A 0.5% fee versus 0.05% fee compounds to a big difference over decades. If you want the exact ETFs I'd recommend for a starter portfolio with tickers and why I like them, so show me the starter ETFs in the comments. I'll make a follow-up video with tickers, portfolio weights, and real-time examples. If you found this useful, hit like, subscribe, and ring the bell. Drop any questions in the comments. I read them and I'll answer the best ones in the next video. Thanks for watching. Invest slow, think long, and I'll see you next time.